Welcome back to High Dividend Explorer. If you are serious about reaching financial freedom before 65, today's video is a must-watch. We are diving into two powerful exchange-traded funds, Vanguard Dividend Appreciation ETF, known as VIG, which is a growth-oriented dividend fund, and Global X S&P 500 Covered Call ETF, known as XYLD, a high-yield income fund that generates cash flow through covered calls. Which one will get you to financial independence faster? Stay until the end, and you will know exactly which fund fits your portfolio and investing style best. Oh, and before we begin, if you love learning about high-yield investing, hit that like button and subscribe. It is free, and it helps us bring more great content to you. Also, drop a comment below. Are you Team VIG or Team XYLD? Let's get the debate going. First up, Vanguard Dividend Appreciation ETF, also known as VIG. This exchange-traded fund tracks the S&P US Dividend Growers Index, which focuses on companies with a long history of consistently increasing their dividend payouts. Expense ratio: this fund charges an annual fee of 0.05%. If you invest $10,000, you will pay just $5 per year in fees. Total net assets: this fund holds approximately $208 billion in assets. Total holdings: there are about 337 stocks inside this fund, including some of the biggest companies in the world, such as Apple, Microsoft, and JP Morgan Chase. Dividend yield: the current dividend yield is relatively low compared to high-yield funds, but it has a strong track record of growing dividends over time. Dividend payouts: dividends are distributed on a quarterly basis. This exchange-traded fund is all about long-term compounding. If you are looking for steady capital appreciation with dividend increases over time, VIG is a solid choice for your portfolio. Now let's talk about Global X S&P 500 Covered Call ETF, also known as XYLD. This fund takes a completely different approach compared to VIG. Instead of focusing on growth, it generates income by selling covered call options on the S&P 500 index. Expense ratio: this fund has a higher annual fee of 0.60%. If you invest $10,000, you will pay $60 per year in fees. Total net assets: the fund holds approximately $3 billion in assets. Total holdings: this fund tracks all 505 stocks in the S&P 500 index. That means you will find companies like Apple, Microsoft, Nvidia, and Amazon at the top of the portfolio. Dividend yield: the fund currently boasts an impressive yield of approximately 12%. Dividend payouts: unlike VIG, this fund pays dividends monthly, making it a great choice for investors who prefer regular cash flow. The trade-off: XYLD sacrifices upside potential in exchange for high monthly income. Because it sells call options, its capital appreciation is limited, which means it may underperform in strong bull markets. However, the consistent income makes it a reliable option for dividend investors, especially in sideways or bearish markets. Now let's put these two exchange-traded funds head-to-head and compare them in key categories. Growth potential: VIG has historically delivered strong, long-term growth, as its focus on companies with increasing dividends leads to capital appreciation over time. XYLD, on the other hand, has lower upside because it trades away growth potential for immediate income. Total returns with and without dividend reinvestment: over the past 10 years, VIG has averaged annual returns of approximately 11% with dividends reinvested. If you started with $10,000, your investment would have grown to nearly $28,000. XYLD has returned closer to 6% annually with dividends reinvested. A $10,000 investment in XYLD over the same period would have grown to about $18,000. If dividends were not reinvested, XYLD would have paid significantly more cash flow, while VIG would have had higher capital appreciation. Bear market performance: covered call strategies like XYLD tend to outperform in flat or bearish markets because they generate income regardless of market direction. VIG, on the other hand, is more dependent on stock price appreciation, meaning it might experience larger drawdowns during downturns. So, which one is better? If you prioritize long-term growth and dividend increases, VIG is the better option. If you want consistent monthly income now, XYLD is the way to go. To wrap things up, VIG is best for investors focused on long-term growth who want their dividends to increase year after year. XYLD is better suited for income-focused investors who prefer steady, high-yield monthly cash flow. Remember, there is no one-size-fits-all solution in investing. Your choice depends on your financial goals, risk tolerance, and whether you prefer long-term appreciation or immediate passive income. Before you invest, always do your own research and consider consulting a financial professional to find the best fit for your portfolio. And hey, if you enjoyed this breakdown, hit that like button and subscribe for more high-dividend investing content. Let me know in the comments. Are you picking VIG for growth, or is XYLD's income stream too good to pass up? Until next time, stay informed, stay invested, and keep exploring those dividends.